Hello, everyone. I'm Lori Taylor, a senior counsel in Foley & Lardner's Business Litigation and Dispute Resolution Group, and along with Foley partners Steve Cade, Belinda Morgan, and Chris Rasmussen, one of the co-sponsors of Foley's Chicago Corporate Counsel Institute, or CCI. We started the CCI back in 2017 to provide in-house legal teams with practical guidance on both hot legal topics and issues corporate counsel encounter on a regular basis. The COVID-19 pandemic has increased the pressures on in-house counsel, both with sweeping law changes and the need to master new ways of communicating and getting work done. In this year's virtual CCI, which will be held this fall, we'll discuss the pandemic's impact on various areas of law and how it may affect the legal industry in the future. In this video, Steve, Belinda, Chris, and I discuss recent trends in mergers and acquisitions, an area where our usually separate practice areas come together. We hope you'll enjoy it and that it will provide you with some insights you can use. We look forward to seeing you at the Corporate Counsel Institute this fall.
Great. Steve, I'm going to start with you. I know when the pandemic hit at the beginning of early 2020, M&A deals really dried up fast, and it seemed like companies just reflexively drew back because they were unsure about how things with the economy were going to play out. Lately, though, it looks like M&A activity has started to pick up again. Are you seeing the same thing in your own corporate M&A and startup practice? What do you think is driving that?
No, you're completely right, Belinda. M&A and other strategic transactions certainly dried up and very quickly at the beginning of the pandemic, particularly given how little we knew about COVID initially. As we all know, the pandemic has produced a lot of economic uncertainty and widespread business interruptions. We have certainly raised some, which have certainly raised some unique considerations for buyers and sellers contemplating M&A transactions. M&A had been very hot over the last several years, and it certainly dipped during the initial months of the pandemic, but the dip in activity didn't last long, and recovery started in the second half of 2020, and has certainly accelerated in 2021. There are numerous reasons for this, and I'll just highlight a few. One, we're just seeing a lot of sellers hitting the M&A market for various reasons. Some sellers have businesses that have fallen into distress during the pandemic and require capital to continue operations. Also, you just have your traditional private and financial investors who are always considering exit opportunities, and they certainly want to capitalize on certain businesses and industries that may have been experiencing higher valuations in the market today, by essentially weathering the storm through the pandemic. There are a lot of buyers that are paying premiums for those businesses that, somehow have weathered the storm and have actually, thrived during the pandemic. Also, some sellers are reassessing their overall business models and strategies, and they're realizing that they have some non-core assets that they're looking to divest so they can actually take advantage of some of the relatively high valuations that we're seeing out there. This is particularly as corporate buyers are actually looking to deploy cash on their balance sheets. And, on a somewhat related point, a lot of corporate and strategic buyers are taking advantage of lower borrowing rates to help finance growth through acquisitions. I mean, rates are very low at this point. I guess turning to the buy side, I talked a little bit about the sell side, but on the buy side, I've definitely seen some of our investment banking partners investing more time and resources in digital banking and other sorts of digital M&A processes that have extended their market reach, and that has indirectly increased M&A activity as well. One very popular trend that we've been seeing is the use of special purpose acquisition companies, commonly known as SPACs or blank check companies, to complete acquisitions. SPACs, I believe we all on this panel know, but SPACs raise money through IPOs and have been a fairly attractive option for investors or smaller companies, usually PE firms, to raise money and make acquisitions. And lastly, from my own personal experience, I've definitely seen an uptick in parties using earnouts to bridge the valuation gap. Earnouts can be a great tool for buyers and sellers who genuinely want to do a deal but can't come to terms on the overall valuation. Generally speaking, this is my personal opinion, sellers usually face much more risk when agreeing to an earnout structure. But I see some sellers willing to take that risk, particularly as we begin to see the light at the end of the pandemic tunnel. So those are just a few trends that I've been seeing, and I'm sure folks on this panel have seen others, but we'll save those for another time.
And how has the pandemic affected the ways in which deals are getting done? Has everyone just moved to Zoom to negotiate? How is that working out, Chris? What have you seen in your own M&A practice?
Sure, I've definitely seen that trend accelerating. That is the trend of doing virtual negotiations, virtual diligence, virtual closings. It's been ongoing, frankly, from the time that Steve and I began our careers, close to 20 years ago. At that time, it would be very common that you're negotiating by virtue of conference calls. You're doing diligence in virtual data rooms, which would be hosted by any number of third-party administrators, such as Merrill DataSite, Firmex, Intralinks. If anything, I think that the pandemic has shifted much of what would have happened on conference calls with audio only onto a video negotiation and video conferences. And we were seeing some of that before, but obviously everybody has access now to a number of video conferencing sites, whether it's Zoom or Google Meet or Microsoft Teams or any of those that we're all very familiar with over the past few years. So we've definitely seen that as a way to improve the efficiencies of negotiations, to improve the efficiency of due diligence. Frankly, I think that adds fuel to the fire of this uptick that we've been seeing in M&A, because it makes transactions fairly seamless when you don't have to travel, when an investment bank doesn't need to go do a physical roadshow to meet up with 10 to 20 different potential buyers. It can be very quick and simple to get from an initial auction process all the way to a closing. And if you're able to bridge that final gap with an earnout, then so much the better. You're able to get to the closing extremely quickly and get your deal done in a way that you would not have been able to before. But one thing that hasn't changed is the need for a specialist to help with diligence in their specific areas of expertise. And if anything, we're even better now at all gathering together virtually. So Belinda, you and I have worked together, including with Steve, on a number of deals. Your focus is employee benefits and executive comp. Are you seeing changes in the types of issues that buyers and sellers are facing as they integrate their businesses and their workforces?
Yeah, I'd say that's a good question, Chris. Yeah, we are seeing changes. Anytime benefits-related laws are enacted or get changed, that'll change the documents that we review and the questions that we're asking while we're doing diligence for a deal. For example, Internal Revenue Code Section 409A was a big change for us. Section 409A covers any arrangement that includes an element of deferred compensation. So its scope is pretty broad. It's broad enough to include employment agreements, severance arrangements, or even option plans. The penalties for violating the 409A rules can be really significant, both for employers and employees. So we now review those types of arrangements really carefully to make sure that the seller has drafted them and administered them correctly. Buyers are looking at that, obviously. The Affordable Care Act, or the ACA, was another big change. Since the ACA's adoption, we're now looking at whether sellers are first even subject to the ACA, and then if they are, whether they're offering affordable and compliant healthcare coverage to their employees, and then filing all the needed information returns for the IRS. Like 409A, the penalties for noncompliance with the ACA can be really steep. Now, with all the new changes with the COVID Relief Act, the CARES Act, that was enacted last year, and in the new American Rescue Plan Act, both of those include benefits changes. We've got the new COBRA subsidies. We'll need to consider all those types of laws at this point.
Well, that's pretty standard for all areas of due diligence, isn't it? There's always going to be new laws, right?
Yeah, that's true, Lori. We're basically always going to be looking for something new. The diligence process is about helping our clients discover any compliance problems or transition concerns that might complicate the deal, and then figuring out how to correct or mitigate them. With compliance problems, our clients need practical advice for how and sometimes even whether to correct them. And that'll depend on the scope of the problem and the risk that it poses to the client. whether that's from a monetary or a regulatory, or in my area, it's from an employee relations standpoint. It might involve revising the purchase agreement or requiring correction of the error even before the sale closes. Sometimes we find errors that will seem small at first, but they actually can pose a big risk to the buyer or the client generally, if it's a seller as well. For instance, in a recent deal that Steve and I worked on, we found that the seller hadn't filed a number of annual returns for its health plan. And while that's not a really earth-shattering problem, you wouldn't think, if the Department of Labor discovers the issue, it can impose penalties of up to $2,200 per day for each day that the filings are late. So it can be really expensive if you don't address it promptly. Luckily, in this case, there was a correction program that allows delinquent filers to correct those types of failures. And we were able to work with the sellers in that case to correct the filings through that program before the closing and protect our client from any post-closing liability that it might have otherwise faced. With respect to benefits transitions issues, we could draft language for the purchase agreement that describes the parties' obligations to provide benefits to continuing employees after the deal closes, or provide options to the parties for offering benefits in situations where the buyer can't necessarily onboard the employees onto its own plans when the deal closes. Basically, we just, in our diligence process, if we discover a compliance problem or a transition issue, we're just trying to help our clients, whether they're on the buy side or on the sell side, address those issues proactively and before they become post-closing headaches.
Yeah, no, those are some really good points, Belinda, particularly in diligence. And, we try to do the best we can to avoid those. And we try to draft around those the best that we can also to try to avoid any future problems in the actual M&A agreement itself. But obviously sometimes, issues do arise and you do have some sort of post-closing disputes that you really couldn't address in the actual acquisition agreement itself. Lori, as a litigator, what are some of the things that we can do as drafters to help prevent future conflicts or reduce the cost of any sort of litigation or arbitration if it does come to that?
Yes, well, one of the things drafters should focus on is avoiding ambiguity. Once a party is able to establish that an agreement is ambiguous, they're usually allowed to start looking outside of the four corners of the agreement. Once that happens, instead of the written provisions of the agreement governing, you may be able to look at other documents outside of the agreement to try and ascertain what the parties intended when they drafted the agreement. To prevent that from happening, focus on avoiding ambiguity. Some things to look out for when drafting an agreement is to avoid ambiguity are conflicting provisions and inconsistent or undefined terms. A provision might work great in one section of the agreement, but conflict with another provision elsewhere in the agreement, thus creating ambiguity. Make sure the contract is free of internal contradictions. Also be careful with defined terms. I've seen instances where a defined term is defined at the beginning of the agreement and then goes by a slightly different name throughout the agreement. For example, let's say you have the defined term financial statement in the definition section. However, throughout the agreement, the term financial statement does not appear. What does appear is the term financial record. However, the term financial record is not in the definition section. Is financial record the same term as financial statement? Did the drafters intend them to be two different terms but forgot to include one in the definition section? This creates ambiguity and is something you should try to avoid. You may also want to consider whether you want to include a mandatory arbitration clause. I think these clauses are included in agreements because it's assumed arbitration is speedier and cheaper. However, that's not always the case. Commercial arbitration is increasingly becoming much more expensive because it involves extensive discovery sometimes. I've been involved in arbitrations that allow for depositions, which are very expensive. And also I've been involved in arbitrations that sometimes allow for expert witnesses who are also expensive. I've also seen agreements that mandate disputes be resolved by the American Arbitration Association. The parties may be better served by using a private arbitrator and having the agreement require that the private arbitrator apply the procedures of the American Arbitration Association. This approach would still allow for a defined process, but might help to keep expenses down. So those are some things to look out for.
Thanks to all of you for joining us today. We hope you found this chat interesting. We hope you learned a little bit of something that your legal team can use as you consider possible acquisitions or other strategic transactions in the future. We do look forward to you joining us this fall for Foley and Lardner's virtual Chicago Corporate Counsel Institute. You'll be receiving more information about the CCI soon. As always, we think you will find that program informative and full of practical, useful advice that you can use every day. Thank you.